Got it. Hello, everyone, and welcome to the very first official 7investing podcast. I'm Simon Erickson, and I am joined by my team of stock picking advisors, Matt Cochran, Austin Lieberman, and Steve Symington. Gentlemen, welcome to our very first podcast.
Ahoy!
Hey, Simon. Thank you.
Hey, Simon.
And thanks for listening. This is, like we said, our very first time at the podcast, but we're doing this for a couple of reasons. I'd love to start by introducing 7investing to our audience. Our mission is to empower you to invest in your future. We very much believe that the stock market is a great way to compound wealth over long periods of time. We're providing our 7 best ideas in the stock market every month for just $17. But we also have a goal of helping people get more actively involved in investing and saving money themselves. So we're not managing anybody's money. We're giving our ideas out there, but we still believe that investing is very personal, and we want people to be more actively involved in the stock market. For this podcast, too, this is an experiment on our side as well. We're trying out different styles between deep dives into industries, broader trends in the market, an introduction to investing in general, and even specific companies. So please let us know what you think. We're at 7investing on Twitter or info@7investing.com on email. Please let us know your thoughts. We would love to hear them for future guidance for this podcast. But let me check back in with our stock picking team of advisors. We have a very diverse background with this team. We look at different styles of investing for every one of our picks every month. And I'd like to introduce everyone on the team very briefly to talk about their style of investing and what they tend to look at. Austin Lieberman, I will start with you. What is your forte in the investing world?
Yeah, I'm around thereabouts 30 years of age. Also, just want to say youngest advisor on the team of old men that we have here. And I run with that in I've got a lot of years of working and portfolio contributions ahead. So I run a little bit more of a concentrated portfolio of generally 15 to 20 companies. And the companies I'm looking at and the companies that I will be recommending for 7investing are mostly in enterprise software, as well as like cloud computing, and even some, I guess you can call it in the digital entertainment sphere of companies. How about you, Steve?
Well, I actually follow a pretty similar portfolio size anyway, 15 to 20 companies usually. I started out, actually, my background is computer science and mathematics. I worked as a software engineer and sales engineer for 7 years right out of college. I have written about publicly traded equities for the past 7 years after that. But what I did professionally before this, worked for a software company that made image processing software. Underlying it was machine learning algorithms, neural networks, artificial intelligence, and this was, I guess, a long time ago. So I have a unique perspective on that. But you'll see my coverage is very broad-based. My first 7investing pick for March was not an artificial intelligence company. I cover every sector, but I try and find really long-term oriented companies, hopefully the smaller the better, and with huge total addressable markets relative to their size. So you'll see hopefully companies that can disrupt industries and change the way we do things. What about you, Matt?
Thanks, Steve. Well, I'm the most seasoned 7investing investor in life, if not investing. And I generally look for companies with strong economic moats or competitive advantages, preferably in growing industries. And this usually requires a lot of qualitative work, like wading through conference call transcripts and 10K filings. But I don't think there's anything more important than a company's economic moat when investing. And as far as sectors, I generally keep a close tab on fintech or the financial industry. But generally, I'm willing to look almost anywhere for a potential investment.
Yep, and I am a self-described growth investor. I really am just really interested in innovation, how industries are changing over time. Been to a lot of conferences over the years, and I really try to find the companies that are capitalizing on those. So again, great diversity of the team that we have, looking at all sorts of different things. Like you said, Austin's on top of cloud computing. Steve is an expert at AI. Matt's an expert in fintech. we've got a bunch of different styles that we cover every month, and we bring those through our investing recommendations. But gentlemen, I want to talk about the issue at hand today. This is an unprecedented time for the stock market. There used to be a time when seeing a stock go up or down 10% in a single day was actually a big deal. Now that's just something we've gotten used to on every day, it seems like. This is possibly the greatest market volatility that we've seen in decades. And it's really an interesting time for investors overall. We have 7 principles that guide our investing style, but I want to go around the horn really quickly and talk to everybody about how do you see this current coronavirus crisis? How is this impacting your investing style, or what do you think about the recent market volatility, and what should we be passing along to investors? Matt Cochran, if you're okay with it, I would love to start with your thoughts on this one.
Yeah, so the thing is, Simon, I mean, I don't have any concrete answers. This is almost unprecedented for almost all investors alive today. What I would say, though, and what helps me invest in times like this is take the pressure off. Like, forget about timing the exact bottom. Like, it's not about, when people talk about the financial crisis, you always look at how high stocks are off the March 2009 lows, specifically March 9th. Like, oh, how much would have this stock gained? But for almost a 2-year period, stocks were 15% below their 2007 peaks. So you had plenty of time to get in stocks at good valuations. So take the pressure off of trying to find the exact bottom, and just when you see a good company, a quality company, one with a competitive advantage, and it's trading at a decent valuation, don't be afraid to pull the trigger. This is we're investing with money that we shouldn't need in the immediate future. And if you buy quality companies at decent valuations, you're going to see that pay off in the years to come. So take the pressure off. Don't feel like you have to time the exact bottom. If you buy a stock and it goes down 10% the next day or the next week or the next month, that doesn't mean you made a bad investment. What about you, Steve?
I think you made an excellent point. One of our principles is to not put money to work in the stock market that you're going to need over the next 3 years. This is money. We're not day traders. You're going to find that we make stock picks with the intention of buying and holding them for years, not months, not weeks, not hours, like some people do. And we're thinking long-term plays, and over longer periods of time, it becomes much easier to predict what these stocks are going to do, assuming your thesis continues to play out. And that's the challenge I think we run into, is that particularly given the timing of our launch, we watched the S&P 500 fall almost 12% in the 5 trading days before we launched on March 1st. And it's down another 22, 23% right now as of this writing. The Dow was up at like 11% today. Biggest point gain ever in a single day. That's absurd. It's not normal. And if you buy a stock, like Matt said, that falls immediately after you bought it, well, for one, keep in mind we talk about continuously investing, just continuously adding to the market in both up markets and down, and that's how you build wealth over the long term. What do you have to add to that, Austin?
Yeah, this is an area I was joking about being 30 years old and younger than everybody earlier, but this is an area where it makes me so thankful to be surrounded by smart people like you. But more than that, to have a community, and that's not advertising for 7investing here, but like that's one of the reasons I'm proud to be a part of this, is because I think we're trying to provide that type of community for individual investors out there. Because I've never been through anything like this as a person or an investor. And when I say as a person, I mean I was in college in 2008 when the great financial crisis happened, and so I wasn't really a person back then. No, but really I didn't have a full-time job at that time. I was a student, and I wasn't managing my own money or investing. And so the first thing I want to say is that this is like a big, scary event. And really one of the lessons I've learned so far, and I would say it reinforced this, is just the importance of like living below your means if you can, and investing 10% or 15% of your income or whatever that percentage that you can, and slowly building that up. Because with that, you're building a cushion in your living expenses. And if something completely out of your control that, nobody saw coming 3 months ago happens, it gives you a little bit of flexibility and it relieves some stress. So that's the first thing. And then again, echoing Matt and Steve, what you said is not investing any money you might need in the next 3 years. Definitely not exposing yourself or myself with things like margin. We just see so many devastating mistakes happen when people do that. And you can read about it all the time, but it's really taken me experiencing this so far to learn kind of by fire how important those habits are. And so that's been my biggest takeaway. And then exactly like you said, so if you have those things in place and you're putting money in every paycheck or every other paycheck or whatever, then I kind of continue to invest that in the best companies that you can find. And those are the companies that we're going to be recommending each month, and not worry about like what's going to happen in the next week, the next month, or the next year, because nobody knows. But I truly believe, and one of the things, so I wrote about this in my monthly update, just looking at 5 incredible companies back in 2006, 2007, Alphabet, Netflix, Priceline, Amazon, and Starbucks. If you would have held them from 2003 through 2020, Netflix is up 15,000%, and Starbucks, the worst performing, is up 542%. And that includes the great financial crisis, which is one of the worst drawdowns in the history of the stock market. And so looking at that kind of puts it in perspective. Find the best companies, have a process where you can invest in them and hold them, and then just stick it out until you're getting to 3 or 5 years where you need that money, and then make sure that money is not in the market. That's what I'm trying to internalize. What about you, Simon? How about from your perspective?
Well, first of all, I would like to pass along that Austin truly does impart not only his wisdom, but his sense of humor to the rest of us elderly and distinguished gentlemen on the team. So always appreciating his perspective on that. My thought is that, to go against conventional wisdom, which is when there is a recession, depression, bear market, whatever it might be, to hunker down and be conservative and stockpile cash. I tend to think of every time that there is a downturn in the market, it's a huge opportunity for the people who are thinking longer term. And you've heard each one of us on this team talk about longer term. That really is an opportunity to grab the stocks that are selling off because of broader market sell-offs rather than individual company news. We're all long-term investors here. We're looking for at least a 3-year plus time horizon. We've got some really contrarian picks coming out, by the way, for April, which are definitely, I think, opportunities for the long term that could still experience some short-term pain. And so I think we're all on the same page of looking for the long term on that. Gentlemen, I'd like to talk also a little bit more about kind of how do you think this is impacting the investing world? I mean, we've said that this is a short term. We think it's going to be an opportunity for long-term investors, but are there certain industries or certain trends you're seeing developing, or maybe even specific companies that are really on your radar right now with all of this crazy volatility going on? Steve, how about we start with you? What's on your radar?
You mentioned in your update earlier this week when we were talking about coronavirus specific updates that this will accelerate. It seems strange to say because the internet is everywhere, but it will accelerate the shift to the internet. There are industries that have not gone there or not relying on the web as much as they should be. And I think investors, and we are for sure, looking at companies who will benefit from that acceleration to the internet. Not only your more obvious like e-commerce plays, you've got, of course you have your Amazons in China, you've got like the JD.com, but more some of the behind the scenes companies that are helping support the enterprise shift to the cloud and cloud computing infrastructure. and supporting the background. Now, you'll notice if you look at our March picks, some of those companies were included there actually. And without naming names, go take a look at our recommendations there, and you'll see some of those included actually in our upcoming April 1st round of recommendations. But really don't be surprised if we're pulling more of these names out of our hat that are sort of your underappreciated, undervalued companies that have basically been smashed in this massive pullback that we think are underappreciated plays on this shift to the internet. That's one of the big trends I think investors should be watching.
Yeah, I think,
yeah, go ahead,
Steve, to kind of echo what you're saying. So there's so many interesting things going on right now. To me, there's a lot of industries and companies that are like almost skyrocketing on the idea of work from home. Zoom specifically is a company, huge fan of Zoom. I actually own shares of Zoom, but I recently trimmed that position just because I think that it has gotten so excessive with this move to work from home. Still own shares, but just trimmed a little bit. So that's kind of one in the opposite way that I've been watching, but took the opportunity to trim my position there and then reallocate that to companies that I think sold off in industries that I don't believe deserved to have sold off. And so I'll talk about those right now. And same thing you're saying, Steve, I think edge and cloud computing for sure are it's an interesting category to me. And it's funny, initially, some of the edge computing companies, Cloudflare and Fastly sold off, and even Akamai sold off. But now we've kind of seen them rebound. And Cloudflare shared an interesting blog post, and we can share this in our show notes. It's called "On the Shoulders of Giants: Recent Changes in Internet Traffic," and it just talked about. And I'll give one quick stat from this article. Evolution of traffic in quarantine. Italy has seen a 20% to 40% increase in daily traffic since the lockdown, and this is daily internet traffic. And so that's a trend that I think it's excessive right now. It'll probably slow down a little bit. Every company is thinking about, even more so, a digital strategy, thinking about how they can get applications and customize applications out accessible closer to their users so they can have that fast experience. And then also probably not relying on some of these big cloud players as much, just in case something unexpected happens. So really interested in the edge computing industry still. How about you, Matt?
To that,
go ahead, Steve.
Actually, I read just before the call, I read an update from Facebook, I think, that was saying they saw like a 50% surge in messaging traffic, but their advertising traffic has gotten crushed, their advertising revenue. But it's interesting, what do you think as an investor? There's a huge surge in messaging traffic. Someone has to support that. And but at the same time, you have other industries like advertising that are getting hurt. So there's opportunity here for people. But yeah, go ahead, Matt.
Yeah, no, those are all good points. I'm always looking at financials and fintech, and right now more than ever, the thing I'm looking at in these companies is their credit exposure. This risk is especially applicable for companies whose entire business model is based on making loans, and it's not at all applicable to companies with no such exposure. So a good rule of thumb to remember is that companies with credit exposure, well, they're always going to get a lower valuation multiple, and they're always going to see a much sharper sell-off during an economic downturn than companies with no such liability. So just look at all the four major U.S. credit card companies: American Express, Discover, MasterCard, and Visa. American Express and Discover, they're down much more. As of today, as we're recording this, American Express in the last month is down 38%. Discover's down 55%. But they hold a lot of credit exposure. They're always, their whole business model revolves around like them making loans to consumers and commercial businesses. And on the other hand, MasterCard and Visa, they have no credit exposure at all, and yet they're still down 25 to 30%. So it's not always, especially in the financial industry, it's not always about the companies that are down the most, but like I look at companies that might be down, but yes, in a recession, if we're headed that way, there will be less spending. But they're at the end of the day, they're not going to be holding any of that debt that might be defaulted on, in a recession. So that's just the thing I look at when I look at the financial industry right now. You see a lot of these banks, a lot of these newer fintechs that have new ways of making loans, but those companies right now are ultimately holding the bag for all this debt. And then you have other companies that have sold off a great deal, like MasterCard and Visa, and yet they don't have any credit exposure at all. What about you, Simon?
Yeah, I'll continue the financial trend too, Matt. I think that right now, both the president and the Fed are going to keep rates very low, the interest rates very low to stimulate the economy and do whatever they can to support that. And I think that one industry that's going to benefit from that is going to be the real estate industry. And so a company that's on my radar right now is Redfin. Now, there's going to be some short-term pain from this, I believe, because the last thing that people are thinking about right now is moving into a new house when the coronavirus is out there. But you think longer term, what could low interest rates mean for millennials that want to buy new homes? Redfin is the largest online brokerage for real estate. This is an $80 billion industry. There were $80 billion of commissions that were paid out to real estate agents closing new purchases and mortgage originations last year. And Redfin is doing that either for a lower percentage or also using data to really take a lot of friction out of that home purchasing process. And so this is a company that to me is disrupting a really large industry. They're doing it in a smart way. I think that the trend of low interest rates is something that could be very interesting for that company right now. Moving along to the next segment, this is one I'm pretty excited about because we asked on Twitter if you had questions that you wanted to ask our team. And we got an incredible response. We're very thankful for anybody who submitted questions, not only on Twitter directly into the threads, but we even got some audio questions that came in through the site that Austin posted as well. And so we're going to take some of those listener questions. Austin, I'll throw it back over to you because I believe you actually have access to the audio question that was asked to us. Can we take one of those to start up the listener questions segment?
I do. Yeah. And echo that, Simon. I've had little podcasts of my own before, and it's like anytime you get listener questions, it's such a rewarding experience to be able to answer listener questions. So yeah, thanks everybody for asking. And then we got 2 people that submitted to our messaging service. So we're actually going to play one on air. Unfortunately, we couldn't get to both of them. We'll do maybe like a question only episode one time, and we can get to a bunch more questions. But so please continue sending them. We really appreciate it. And yeah, let's get started with this one. This one is from our friend Rampant Discourse on Twitter. His name's Paul Essen. And here we go.
Hello, 7investing. My name is Paul Essen, and my question to you is simple. What do you guys see as the best opportunity in the market right now? Is it a beaten down stock like Boeing or some of the cruise lines or maybe the airlines? Or is it a higher quality company like Visa or MasterCard? Or is it something else entirely? Thanks for taking my question. Looking forward to the podcast.
So we're big fans of Paul. I know all of us are. But when I first heard that question, Paul, I thought you were trying to squeeze some 7investing recommendations out of us early. So Simon, before I answer, I'm going to go ahead and take this as an opportunity to tell people April 1st, our next round of 7investing picks are going to be out. Subscribe, $17 a month, and you'll get them. All right. That was my last plug. So I'll start. What I'm doing here, there's a lot of companies that are just beaten down, 75% plus cruise industry companies, Boeing, companies like that. I'm not interested in a single one of those companies. I think we've got a friend on this podcast that likes some of those turnaround type stories, but it's just not the way I invest. So, Paul, great question. What I'm looking for right now is strong companies and strength. So these are companies that I was already interested in, and this is kind of my filter. Ask myself, was I already interested in this company before this sell-off happened? And if my answer to that question is no, then I'm not even considering it now just because it's sold off. There's so many other companies that are great that have sold off a lot, and I think there's incredible opportunities. So it's got to be a company I was already interested in, and I'm looking for companies with strong balance sheets, preferably that are free cash flow positive or even profitable, so they're making net income. I'm okay if they're not quite profitable yet, but I want to see a company that is making progress in those two areas. And free cash flow positive just means that they are bringing in cash every quarter from their operations, and which is a good sign that that business is on the track to becoming more profitable. How about you, Matt?
Now, I'm mostly with you, Austin. Most of the time, I'm just trying to trade up in quality. I think Simon actually tweeted about this the other day, about trading up in quality in your own portfolio, taking advantage of opportunities like this. I will say, like, some of these things you see in the market, though, are very enticing right now. And there's nothing wrong with that. The only thing I'd caution anyone when you're really going dumpster diving for these companies that almost have bankruptcy priced in at some point, just look at their balance sheet before you invest in anything. If there's a chance, if they're being priced for bankruptcy, there's probably a reason for that. So the only thing I would say is there's nothing wrong with looking at these companies that have had their faces ripped off. A lot of times you can make some good money in those names, even though you might have to be patient waiting for sentiment to turn, but make sure they have the balance sheet to withstand like an economic downturn. But as for myself, like, I'm just personally looking for mostly quality that has sold off with the market. What about you, Steve?
Hey, and Austin was referring to me when he's talking about our turnarounds. That I like a good turnaround, but I'll be honest, when I've had so many people personally come up who know what I do for a living and ask me, "What do you think of airlines right now? What do you think of Boeing? What do you think of the hotels?" And they're honestly terrifying to me. They're, even if it means missing out on some huge pops, when you look at these stocks and you see some of them up 60% in a day because there was some news that indicated they're going to survive, that's just too much risk for me. And I stay far away from those companies, because I think the market has yet to realize the gravity of the situation and just how badly the results of many of these companies are going to get smashed over the next couple of quarters, and some will not survive, and that's okay, but that's not a risk I'm willing to take. So I like Austin said, like to look at some of those companies that I was interested in anyway, that have gotten beaten down for, in my opinion, no good reason. That's kind of where I tend to shift. What about you, Simon?
That's good. Just real quick, that's a good point, Steve. A lot of these companies too, right now, they're just trading on bailout news, and it's like you're almost betting on if these companies are going to get a bailout from Washington D.C. or not. And that thought just terrifies me. Like, anytime you're counting on Congress and the president to do something.
Well, and it's not free money either.
Right. Oh, absolutely. But like, and you're just like that, but that's what you're betting on, that these companies are going to get a bailout so they won't go under. And when as soon as you're not trading on companies, not trading on fundamentals, but on a possible bailout from Washington, that's a scary thought. It's very risky.
Well, then I have one other question for you, Mr. Contrarian, Mr. Turnaround, Steve Symington, which is still on the same theme. We have another question that is very similar, which is from Kevin Zatlukal, KCZAT on Twitter. Apologize if I mispronounced that. But he asks, what's a better buy? A stock that has dropped more than the market during the drawdown, example, Middleby, or one that has dropped less than the market during the drawdown, example, Amazon. Steve, any thoughts on that? Turnaround stories versus high quality companies that aren't selling off as much?
Oh man, that is such a good question. And sometimes I find myself spotting companies that have fallen harder than the market, and if I've determined that their thesis is still intact, I'm all about either opening or adding to a position in that. But by and large, you'll find that your winners do tend to keep on winning, and companies that are operating from a position of strength will continue outperforming. So you'll see, take Nike, for example. They just released earnings, and I think their executives on the call were talking about how stronger companies tend to just get even stronger in situations like this. So there's risk both ways. But if you want to minimize that risk, I think you go with the stronger businesses. So,
great answer. We had another group of questions come through. Thank you to Andy Wolford. and also to DJR, who both submitted similar questions about what companies do you think have increased engagement with their services due to the self-quarantine? And then also, what are some of the trends that you think are either the strongest or the most vulnerable going forward? And I'll take the first shot at this one because this was a topic that I just talked about in our last advisor update that we put out. But it's basically, in my opinion, I think that 2020 is going to be remembered as the shift to the internet, even more than it has been before. We've seen Amazon has been the king of online shopping, but still, everyone hasn't been buying things online. There's still a lot of bricks and mortar retailers that are out there, and people are still going and shopping in person. I think this accelerates because everyone's been in quarantine, everyone's been stuck at home for this past month. I think this accelerates those people that were not doing online shopping even farther in the retail industry. And then the other thing that I think that we've seen has been a complete spike that is just too much for our current healthcare system and hospitals to handle. There is an oversupply of people coming through hospitals. It's more capacity than they can handle. And I think the next big trend that this really accelerates is a shift to telehealth, where you're consulting with a doctor for non-serious conditions over the internet through a consultation that way. And then also just an availability of lower cost healthcare too. We've seen companies like CVS setting up prescriptions in neighborhoods where you can get a minute clinic to check you out. You can get a prescription right there. Boom, you're in and out without even having to go to a hospital. There's got to be a more accessible way and a lower cost for our healthcare system. And I think that this really puts that into the forefront. Austin, what do you think? Is there any trends that you see developing out there, or companies you think that are well poised?
Yeah, I mean, again, kind of the same thing we've been talking about here, echo a lot of the same thoughts, so I don't want to repeat those. What I would caution investors to be careful of, again, are the companies that are maybe getting pumped up a little bit excessively with predictions that this is just going to be an absolute game changer for them. Again, Zoom is an example, and even we've seen things in the news about Peloton, the company, just all these massive shipments that they're doing. It's easy for individual investors, retail investors, to get caught in kind of the FOMO of those stocks rocketing up, and then also be caught as the ones owning them, as some of these high frequency traders, funds, whoever it is, takes their profits and gets out of them. So yeah, that's kind of how I'm thinking about that, outside of just the clear shift to owning companies that have good digital strategies and have already been benefiting from e-commerce, the move to digital and things already. Just be careful of things that are a little excessive right now. Go ahead, Matt.
Yeah, so I guess, we're talking about the shift to internet, and it's almost like for retail, it's not just the shift to the internet, but it's this omni-channel, this idea of don't have a separate digital experience from a physical in-store experience where it's just all blended. And in fact, we have coming up on April 1st, we actually have two team picks that I think like that follow this trend where they just have a fantastic omni-channel experience where it's not it's not always the tech companies that make the best investments, but also companies that know how to use technology to enhance their own experience. What about you, Steve?
Speaking of that, one of the industries that's kind of interesting to me right now, and one of those industries that has a harder time shifting, is the restaurant industry. People think of hospitality and they think of airlines and hotels and everything, but I think there could be opportunity in food service specifically. They do have sort of an omni-channel approach where you can do digital ordering, you can do deliveries that are online orders. I've never liked, by the way, the economics of food delivery. The Grubhub, feel free to prove me wrong, but I've never liked it. I like to stick to the companies that are benefiting from these trends anyway. But I do think there's going to be some opportunity for businesses that were uniquely positioned to benefit from takeout, fast food, fast casual to begin with. To actually generate outsized gains for investors. I think, some of your McDonald's, your Chipotle's, maybe even Papa Murphy's, those kinds of companies that were actually positioned well. I also wonder if this is going to have a more concrete, longer term shift in consumers' dining habits, further away even from casual dining. So, your more traditional sit down experience. So I think that's an area we should be watching going forward. What do we have next?
Yeah, great points on all of those. We've talked a lot on this podcast about kind of higher level market changes, broader based questions. Let's get a little bit more into the weeds here, guys. Question from the Animal 23 is what is your take on Roku moving forward and its market cap potential? And I will couple this with another question we got from Luis, who is asking, I would like to hear your thoughts on 5G and the streaming wars and what companies are paving the way for the future of these trends. So this is kind of a bigger question, but Roku is obviously very involved with streaming, which is kind of connected in some ways to 5G and mobile devices streaming things from the internet. But maybe the first part, Roku. What do you think, Austin? Can you handle the Roku part of this question first?
Yeah. So love the Animal on Twitter. Interact with them all the time. So appreciate the constant feedback and dialogue on there. And the question, Roku, I've had such an interesting relationship with Roku. I've owned it and sold it so many times, and which is, generally not good. But again, when we talk concentrated portfolio, I've only got room for so many companies. I currently own it right now, and I have increased that position significantly recently. And I actually just tweeted about this, and I was thinking out loud and got some good comments. I like Roku right now better than the Trade Desk. And the reason why is I think the Trade Desk is a great platform, great founder-led leadership. But right now, with the opportunities that are available now, Trade Desk really relies on advertising revenue from their different partners, and I think advertising revenue is going to get hurt over the next year or so. Roku has sold off significantly. It was up around a $20 billion market cap, sold off down to around 7, and is currently sitting at about a $12 billion market cap. So still significantly off of its high. And I think some of that is overdone because Roku doesn't just benefit from advertising, but they've got an awesome digital channel and digital platform, and they actually take a small percentage of some of the subscription service. So you can subscribe to HBO and Showtime and these different premium channels from Roku, from your Roku device. And if you do that, Roku keeps a small percentage of that. So I think those sales are potentially going to increase, a little bit or substantially over the next year or however long we're quarantined or whatever. And that's a habit that I think is was probably sped up, was the move from live TV to connected TV. And so that's Roku, and the Trade Desk benefits from that as well. But so I think Roku is going to continue to benefit. I like the company right now. I own shares, and in terms of market cap potential in the future, I think there's a chance that one day it's more than $100 billion company. And I don't make exact or precise estimations. I think a lot of times they're wrong, but I just think in terms of, can this 5x or 10x? And I believe Roku is a company that can. And then Simon, I think you're going to talk a little bit more probably about the 5G question, because I know you've been studying that.
Well, actually, I wanted to kind of elaborate on also what you said about streaming, because just to add another perspective to that also, we always say content is king, right? Good content is expensive to produce, but time is also very precious, right? We have limited time. You can't go watch every show on the internet or anything that's provided on connected TVs or any media for that matter. So, combining the two of those, that time is precious and good content is expensive, I think a lot of these streaming services are realizing they have to be ad supported to support the good content that they want to spend money on providing. And so my take on this is that we're going to see as in the shift from linear television to streaming, where you're interacting with the television. It knows who you are. It's serving you personalized ads. I think that we're going to have this completely new advertising market for the shows that we're watching. And it's going to be programmatic, which is based upon just like on a website that you surf on the internet, you're going to see a personalized ad on the side for that. We're going to see a lot more programmatic personalized ads showing up for connected TV and all of these streaming services too. There was a question about 5G. Matt, maybe could you comment on the 5G part of the question from Luis?
Yeah, sure. I'd love to. So 5G, just real quick, it stands for the 5th generation of wireless networks. And it's important because it's going to enable so many of these cutting-edge innovations that are on the threshold of great advancements. That can be anything from smart cities to virtual and augmented reality to mobile payments. They're all going to require high-speed connections to perform to their highest capabilities. The Internet of Things is just going to continue to explode too once 5G infrastructure is laid out. Just real quick, if someone was looking for like direct plays on 5G, there's some companies that like might appeal to different types of investors. So for one, you have Corning, which is the world's leading manufacturer of optical fiber, the material that will act as 5G's backbone. A lot of these telecom networks, they're still copper, and they're going to have to really densify those for 5G to really work. And they're going to need optical fiber to do that, and Corning makes it. Another one is Skyworks Solutions. It just supplies analog chips that connect a wide range of mobile devices to wireless networks, including smartphones. And, when 5G smartphones come out, Skyworks Solutions will have 40% more dollar content in each phone than they did in just 4G phones. And then finally, Verizon. This might not be for growth investors, but for investors looking for income. It's a major telecom carrier that, even though it looks like the 5G coverage is going to turn into a bunch of marketing and marketing gimmicks, basically, like everybody just is souping up their 4G networks, calling it 5G. Like Verizon, I believe, will be the first telecom carrier that actually has true 5G coverage to most U.S. customers first. And they have a great dividend yield, and they do have a lot of debt, but things have to get pretty bad before people start cutting their wireless bills. So I think I like those three: Corning, Skyworks Solutions, and Verizon. Simon?
Any thoughts on that also, Steve?
As far as the 5G / streaming wars go, I mean, I like those picks. I like Corning and Verizon for their generous capital returns. As far as streaming, I think we also ought not to ignore your actual, the obvious streaming place. Your Netflixes. I've watched. It's like owning Netflix through this is a fantastic experience because it's one of the few things that's not getting crushed. One of our other picks in March, I'm not going to name it, but you can look and see it's one of the bigger outperformers in that group of picks. I'll leave it at that. Take a look and you can guess which one it is that works for not just video streaming. I'm watching, I think, do you say it iQIYI? IQIYI, ticker IQ. It's that Chinese video streaming behemoth. They have that ad-supported side and the subscription side. I'll be very curious to see, just because of kind of how far ahead China is in the coronavirus pandemic curve, how their streaming providers hold up, and to see whether it might also translate on a delayed basis to your American providers. So whether iQIYI actually holds up well, if that translates to how Netflix plays, and maybe Prime Instant Video on the YouTube side with their subscription stuff, and Hulu and Disney Plus with Disney. I do love Disney, by the way. What a fantastic play that way. I subscribe to both Hulu Live TV and
so Steve, my takeaway, you're bullish on every streaming
everything
in the world.
And they're They have their pros and cons. It's so hard to pick between them. But personally, I love Netflix and I love iQIYI. Own shares of both, and I think most of them are going to hold up pretty well because people are holed up at home, and it will be very interesting to see whether this again accelerates people's adoption and acceptance. So what do we have next, Simon?
I think that we'll call it at that for the listener questions. We've covered quite a bit of ground here on our very first podcast, in terms of what we're investing in right now, what we think about the current market volatility, a little bit about our backgrounds. We talked about 5G. We talked about streaming. Let us know what you'd be interested in hearing from us going forward. We're here to be helpful. We want this podcast to be useful for all of our listeners. So lob us your thoughts either in an email or on Twitter. Send us a direct message if you'd like. We're here to make this helpful and useful. So please send your comments along. Austin Lieberman, Steve Simonton, and Matt Cochran. Gentlemen, thank you very much for everything on this very first podcast. It's been a real pleasure.
Yeah, and just a heads up for listeners, if you're still with us, next week, we're going to actually have an interview, and Sean Brown from Y-Charts, he's the CEO of Y-Charts, is going to be our first guest. So tune in for that. Yeah, thanks, Simon. Thanks, guys. This was a blast, and thanks for all the questions, everybody.
Indeed.
Yeah, and we'll put some links up to our site as well on the podcast page here, so you can check out more about 7investing. Again, we are offering our 7 best ideas in the stock market every month for just $17. Come and check it out. We appreciate all of your support. Thanks for listening to this podcast, and we are here to empower you to invest in your future. We are 7investing.